All right, guys, welcome back for the last section of day 4 of the Master Trader program. Again, we will be doing a replay of this later at 6 p.m. Eastern Time. Room will open at 5:30. You will be able to continue typing questions in today's chat box after this session concludes. I'll leave the room open for a bit. And again, as a reminder, tomorrow, if you're not going to join us again later tonight, tomorrow will be starting at 8:30 a.m. Eastern Time. Room will open at 8 o'clock. And that is 8:30 is where Mark will start with the pre-market routine, preparing for the market open at 9:30, of course, right through the closing bell at 4 p.m. Eastern, which is when the Master Trader program will conclude. We will be doing questions and answers during the day tomorrow. And I will have some time today to give some of you phone calls regarding the private access membership. I know a lot of people have been writing emails in, and you can also call me at my number 917-268-1800. Most of you know that already. But otherwise, let's get through the last section of day 4, which is the post-trade analysis on page 425, and Mark's wrap up. This section again will last about 45 minutes. See you at the end.
Okay, welcome back. Master Trader Program 2020 Super Performance Workshop. Here with David Ryan. And David Ryan's back, actually. So we're about to wrap things up and finish off with a topic that I think is really important. It's about post-analysis and looking at your trades and your results. Dave, this is something that that I know early on you did, as well as myself and O'Neill. We went back and took a look at our trades and just simply with a green pen, put where we bought them, with a red pen, put where we sold them. And it's amazing what you can learn by doing that. It's a very simple exercise, but I found that things just came to light, all kinds of mistakes that I was making. I not only found out what I was doing wrong, I found out what I was doing right. You can see what you're doing consistently over and over correctly, and you can see what you're consistently doing over and over incorrectly. And what I found, you tell me if you found the same thing, but what I found is that everyone seems to have sort of a common denominator of what they do over and over. For me, I was buying extended stocks. I was giving back a lot of the gains. I'd have decent profits, but I'd give too much back. So I sort of saw a common thread that was going through my trades, and then I was able to make those corrections. How about yourself? How did that, doing post-analysis, what's the way that you did post-analysis, and how did it help you?
Yeah, well, I might have told the story a number of times before, but I think it's so important. I doubled my account. I had a $30,000 account. I doubled it. This was from August of 1982 through somewhere in the summer of 83. But then from 83 through the summer of 84, I lost it all back and more. And I got so disgusted that I sat down one weekend and I tore out of a chart book every stock that I had bought and sold. And I, like you said, I put in where I had bought it and where I sold it. And it was so eye-opening that I was buying everything that was extended. I mean, everything, I don't know why I wasn't buying it right at the breakout. And finally, I said to myself, look, forget this. I'm going to be extremely focused and buying only one setup right at the breakout point from nice, perfect bases. And I don't care what the rest of the market does. And it was from that point on where my performance just started taking off. But it's something that everybody has to do, because we lay all this out, and you've gone through a number of hours in this class and through this material, and we're not hiding anything. The whole idea now is to take this, start using it, and learn from it, but study yourself. Because I can't tell you how many people said, well, if I could just have a seat right next to you and see what you do, then I could put it all together. No, it's really you going through the process of making the buy and sell decisions and making mistakes and learning from those mistakes and eliminating those mistakes and going forward and making money.
Yeah,
So because I can't sit there and tell you exactly what the thought process I'm going through. I can't read your mind, but you have to take this on your own and really learn from it and learn from what you're doing.
yeah, forget about seeing what we're doing. You got to see what you're doing. And
Yeah.
that's really important. And I'll tell you, you know, the two things that really were the big post analysis, or what I did to turn things around, was one was the loss adjustment exercise. When I told you just fix all your losses to say 8 or 10% and go back and see what your performance would be if you happen to be, you know, one of those people who let losses get out of control or add to positions and that are down and average down and end up with big losing positions. You're that's a huge eye opener right there. And the other is what I call visual post analysis, and that's where, you know, we're looking at the trades and seeing what we've done on the chart. And what I call this, I call it grading the trade. Going back now, there's a few things that I'd like to point out that make it more authentic, if you will. First of all, you need to have, you know, a lot of trades if you want to start seeing what's going on over and over. Obviously, you're not going to see it probably in just a couple trades. So, but you know, as you're trading, you're going to have more and more trades. The thing that I like to do is I've always liked to do is put the trade aside for a while and don't do this post analysis right away. Do it months later. And I'll tell you the reason why. Because when you go back, and this is for the purposes of grading the trade, meaning going back and saying, was this a good buy? Was this a good sell? Was this a bad buy? Was it a late buy? Was it an early buy? Did I buy it extended? When you look at a trade after you did it, you know, 3 months later, it's almost like looking at someone else's trade. Like you're not really involved in it anymore. Sometimes you even forget the trade, and you grade it, I think, more objectively, like you're grading a report card for someone else. So the way I like to do this is, and I'll show you, I sort of take everything and try to quantify it in some way. And I've done that with the post analysis too. The first thing is I just go back and I look at the stock trades and excuse me, sorry. I grade them. I grade them whether they were a late buy, an early buy, an early sell, whether they were good buys, whether I cut my loss, all these various topics that I'm going to show you in just a second. But then right there, I can start to visually see whether I'm doing something, consistently. You can see here with this particular trade, this is Ford Motor. Now, I'm going to show you later on, I'm going to show you a hypothetical sort of report card. I turn this into a report card. I'm going to show you in just a second. But these are actually real trades. These are my real trades that I did. I bought Ford right here. Let me get my little pointer here, my spotlight. So you can see I graded that as a late buy. I chased that up a little bit, and I felt like that was a late buy. It wasn't the best pivot point either, but I graded that a late buy. And then I sold it right here. I graded that as an early sell because they didn't even go through a first natural reaction yet. I didn't even let it pull back and see if, what the stock was made of. So it was kind of a quick scalp for, I don't know, what was it, maybe 5 days. Then it tightened up. You can see the stock tightened up, and I bought some here. And then as it broke out, it tightened up a little bit more and broke out, I added to it. Those were great buys. I thought those were really good buys. And now here's a really important thing. You don't look at it and say it was a good buy because the stock went up afterwards. That doesn't necessarily mean you could make a good buy and lose money, and you can make a bad buy and make money. So that's the first thing that you have to get right, is grading these things, grading these trades, whether they're good buys and sells according to your plan and sound principles. So this isn't a good buy because it went up afterwards. It's a good buy because I bought it out of a very well-defined low-risk entry point. I added to it on the way up. Now, again, we went up for, I don't know, 1, 2, 3, 4, 5, 6, 7, 8, I don't know, maybe 10 days or so. And I sold it on the first signs of pulling back. And again, I didn't really even go through a one natural reaction. This was a natural reaction here where I left some money on the table. So I graded that an early sell. I went back and I bought it again. It went through a rebasing process. I do this with a lot of trades. Well, I'll trade in and out of them, and the stock might make a big move, and I trade it 3-4 times, and I make a nice profit just because I've taken a bunch of maybe smaller profits on a larger move. But I bought it right here, and then it tightened up a little bit more, and I felt like I should have bought even more. So I made a little note that I probably should have added or maybe even gone overweight there. But again, an early sell. So now, what's the common denominator here? I sell early every single time, right? So this is one trade. I want to go through a few of these, and then I want to show you how I quantify this and turn it into a report card, and it's really quite eye-opening. So you can do this. You can just go back and start grading your trades. You don't need to do it in a PowerPoint or in something fancy. You can just write it in with an arrow, with a pen. So this particular situation here, I remember when the airline stocks were doing well, and why I chased this up. I mean, I did buy it after it pulled back and it started turning up. Sometimes I'll play a natural reaction. Stock will break out of a base. I might miss it, and then it turns up from a natural reaction, and I'll actually buy it there. I did that. This was an extended pullback buy, so I graded it as just an extended buy. And then the stock turned around. I probably should have got right out of it. I mean, this thing just didn't work out, and I waited too long, and I ended up getting clipped. I took a 10% loss, and I graded that as a late sell. Okay, let's take a look.
I would think one other thing that you should include there. I mean, I don't see any volume at the bottom of that chart, and that can always add a lot more information to when you're looking at the chart. So I would always include that in an example.
Yeah, absolutely. I'm not sure. Let's see. We have some with volume, but absolutely. I mean, you always want to compare price with volume when you're analyzing a chart. But for the purposes here, we'll just show you the price for now. But I think we have some with volume also. But always compare price with volume whenever you're analyzing the quality of the technicals.
Yeah. One other thing I would do that I do sometimes is I put in a weekly chart to get the big picture, and then I zero in on the daily chart. So you get I think as much information you can provide without getting too bogged down is, I think, just helps with your analysis of what you're doing right and what you're doing wrong.
Right, especially if you're longer term oriented. If you're trading a longer term time frame, you want to look at the weeklies, absolutely. And of course, I mean, you could be doing this if you were a day trader. You'd be doing this with intraday charts.
Right.
So,
right.
Right. It doesn't know a time frame. So now here's a perfect example of a sell. Now I took a 15.64% loss, which you might say, well, I thought you never take, bigger losses than 8% or so. Well, I couldn't help it this time. The stock just got away from me. So now I graded this a good sell, even though I took a large loss, because I got out, I stuck with my plan, and I got out immediately as soon as the stock broke down. I didn't sit there and say, well, I'm going to wait till it comes back. I didn't play that game. I just got out. I took my loss. This is an outlier. It's going to be sticking way out on the left side of my distribution curve, and you're going to see a few of those. You're going to have some outliers. This is one of the outliers. So I had a good buy, very tight action, came out. I bought it perfect, and then it came in, and as soon as it got the loss got out of control, I sold it as soon as it hit my stop. But I tried to sell it, but it just kept running and gapped down on me. So there wasn't much you can do there. Okay, so here I remember this really well. This was Baidu, and with this one here, sometimes I happen to be, I'm not convinced maybe the market's really doing that great just yet, and I haven't had stock trades that have logged some gains. So, I'm using progressive exposure, and I haven't really just gotten myself into an aggressive mindset yet. This might have been that. I don't remember exactly what I was thinking, but I know one thing. It came out of a really nice large base. I actually missed the cheat here, and then it came out of a nice handle, big coupled handle. And then, this was, in my opinion, a bad sell. Because I choked off the trade. I mean, it came back to break even. I moved my stop up probably too quickly. Normally, I like to go through a natural reaction, as I've told you before, and then once it gets into new high ground from post-natural reaction, then I move my stop to break even. In this case, I moved it right away. So I choked off the trade, and it, of course, it went through a natural reaction, back into new high ground, and took off. So I graded that as a bad sell, all right? Okay, let's take a look at another one here. So here's another BABA trade. Now, again, this one, I made a nice buy here, and I just put a note in here that I had the patience to wait this out. I mean, it really just sort of moved sideways for quite a while here, and then started moving up. And then you see here, I sold it. And again, I graded this as a bad sell because, again, I didn't really go through much natural reaction, and the stock was acting just fine. So again, what's the common denominator is over and over. You could see I'm constantly selling early. I mean, this, yeah, and just to let you know, I sell early a lot. It may be maybe it's a drawback for me. Maybe I need to learn how to hold longer, and it's something that I work on improving. But I do sell early a lot. I mean, there's a lot of stocks that I'll sell and they go a lot higher, but I also avoid a lot of downside and volatility. So, and I'm swing trading. But again, you're seeing there is a common denominator here. There's something I'm doing over and over. Okay, here's another one, Alcoa. Very V-shaped. I felt like this was a bad buy because it just wasn't the greatest base. It was very V-shaped, but I got out very quickly. It pulled back to the breakout in a sort of, looking like it was a natural reaction, but then it came in and I got out immediately. So I graded that as a good sell. That stock got into trouble there, as you can see. Here's another one. So now, again, I'm not going to say, I could say this is a good sell because I nailed a 20% profit. But no, it's not. It's a terrible sell, and I'll tell you why. So in this particular stock here, GENT was a symbol. I bought it right here. Could have added to it. I mean, it tightened up very nicely, but I think I bought my full position right here. Bought it right here, and then I sold it. Took a 20% profit. But this is a power play, and it's just starting to come out of the base. So I sold it way too soon. Way too soon. Again, selling too early, right? So sold it too soon, took a 20% profit, but the result doesn't necessarily justify the means. You've got to look at it objectively, and it doesn't matter that you made money or lost money. Did you play by your own playbook? Did you follow the rules? Did you stick to your plan? That's the really important thing. What was your plan going in? This is where keeping a journal is very important. If you keep a journal and then you go back and do this, you could look at your journal and see what you were thinking during this trade and then start plotting it. I mean, you bring all this together, journaling and post analysis, you'll find out everything that you need to know about your own trading. And
yeah, but Mark, that's something very important that I do a lot is when I'm buying a stock, I screenshot it and then I write down the reasons of why I'm buying it. And then going back, and then when I sell it too, you can also jot in notes of why you're selling, because sometimes, as you said, you could go back 3 months later and you start saying, what was I thinking? Why in the world did I sell that stock? And if you've taken some notes, you'll be able to realize maybe what you were thinking and why you did that, and maybe why you shouldn't do that going forward.
That's right. You will know what you were thinking, and
Right.
and you probably won't. Like I just told you, I don't know what I was thinking back then. I'm not sure. Now, I actually, Dave, I did that for many years. When I first started trading, I would always snapshot the screenshot the trade, and then I would write down in my journal the notes exactly why I'm buying it, and exactly the same thing and selling it too. So that was something that I did. I don't do that anymore, but I do still do post analysis. Let me show you another one. Let's see here. So here's another one bought really perfect, coming out of a really nice base here. Sold it, a pretty good sale. It got extended, went through a little natural reaction. And again, I'm not saying that, it's a good sale because it didn't do much afterwards or it went down. But I stuck to my plan on this one. This is pretty much, a pretty normal swing trade for me. A lot of times what I'll do is I'll sell a half of it or maybe 2/3 of it, and then I'll play it for a larger move. The rest, I move my stop to break even. So grading these trades, just a few more. Bought one here. Bought Microsoft here, coming out of this cup with handle. And now this took a while and then came back, and I sold it right here, formed a new buy point right here. So again, you can go back and take a look at these and see where you sold, where they form new buy points, how you handle it, if you pyramided up on it. Take your journal and start bringing those notes in, and you'll really find out everything you need to know. Now, here's where it gets really interesting. And what I found is a great exercise, especially if you have a lot of trades. If you're doing this with, you have 100 trades, even 50, 100 trades or more, you can really get quantitative on this. You can really start to look at this data. And what I do is I make what's called my report card. And basically I just break it down into, and you can break it down however you want. You can have different categories. The main categories that I like to have are the entry point, exit at a profit, and exit at a loss. Now, what I do is I go back and I take a look at, and I count up all the stocks that I bought too soon, the ones that I bought too late, the ones that I bought perfect, the ones that were faulty setups, the stocks that I sold too soon, sold too late, sold them perfect, at a loss, the ones that I cut my loss perfectly, I cut the loss too late, and maybe cut the loss too soon, choked off the trade. So those are sort of the headings and the gradings. So now you take that, however many there are, there's 20 out of 100, of course it's 20, and I take the percentages, and let's take a look here. All right, now this is hypothetical. This isn't actually real results, but let's just look at this hypothetical report card and entry point. So bought too soon, 5%. Bought too late, 20%. Bought perfect, 60%. Faulty setups, 15%. So are these good numbers? That's the question. Well, bought perfect, 60%, that's not a very good number. You should really have your buy criteria down. I mean, you should be buying 80, 90% of your stocks should be bought pretty much perfectly, because you've got total control over that. You have total control over that. Now, exit at a profit. Sold too soon. So in this particular instance, this kind of looks like, it actually did grade me. 70% sold too soon. That's probably a number that's pretty close to accurate for me, with all those sales that I did too soon. So now, this might not be as bad of a infliction, if you will, selling too soon, if I'm, maintaining my risk reward relationship and I'm making money, and I'm selling too soon, but I'm still making decent profits. I might be leaving money on the table, but that might not be that bad. So it's sold too late, sold perfect. Can you really, how many times can you sell perfect, right? So this number, you're never going to see that number to be a really big number. So let's look at exit at a loss. So cut losses perfectly. All right, cut them too late, cut them too soon. 65%. So this trader, let's just say, whoever this is, we're analyzing these numbers. Is 65% cutting your loss perfect? Is that a good number? That's a terrible number. That should be pretty much 100%. Because again, this is something you have total control over. You should be going into the trade knowing exactly where you're going to get out at a loss. So the minute it hits that price, you're out. Even like the situation that I showed you where I took the 15.64% loss, I sold it immediately, and I had a drawdown, and I had some slippage, but I got out. I stuck to my plan. So this number should be at 90%, at least 95%. I mean, Dave, how many times do you go back, you look at all your trades, and you didn't cut your loss pretty much according to your plan?
Yeah.
Right? Not too often, right?
Not too often, yeah.
So when you do this, you really start to see what sticks out. You'll see, okay, right here, if we look at this whole report card here, cutting my loss perfect, 65%, that sticks out. That's really, that's a poor number. Sold too soon, 70%. Okay, so there's something to really work on, right? So this really quantifies the information, so you don't just start to just look at it and guess. You want to really get to the bottom. As you can see, everything I do is very, very meticulous, and I try to quantify things and really crunch the numbers. What I've done is I've taken stock trading. Many years ago, I started looking at futures traders and looking at even probabilities for gambling probabilities, and just everything that I could bring into speculation to hone it down, to perfect the risk reward relationship, perfect position sizing, whatever I could do to really get to the bottom of the numbers and take as much guesswork out as possible. And these are, you've seen now over a number of days and many hours of curriculum of all the ways that I've done that, from the fundamentals to the technicals to the math and the risk management and so forth. Real quick, I want to go over
One more thing I wanted to add to this is that it can be painful doing this because people don't like to admit their mistakes. And it's hard to look and see where you were wrong and to admit that you're wrong, but you have to have a humble attitude in approaching this. So then you can change your behavior. So you can, with an open mind, look and see what you're doing wrong and change that behavior going forward, because that will really increase your returns in the market if you can get those mistakes that you keep on doing over and over, if you can get them out of your out of what you're doing.
Most likely for most of you, and pretty much for all of us at some point in time, it's going to be painful to look at this stuff, and it's really important. You know, it's just like a cut. You know, it heals and it scabs up, and you go through a healing process. It's the same thing with your trading. You need to, and this is something that you don't just do one time. You do this periodically, and you do it forever. You always want to keep yourself honest and know the numbers and know what you're doing, and you get just tremendous amount of information from this. So yeah, it's going to be painful. It's going to be painful, and you're going to find a lot of mistakes. But that's the whole idea: is to find the mistakes, root them out, and improve your weaknesses and find your strengths. You want to find your strengths so you can do more of that, and your weaknesses so you can do less of it. Real quick, I want to just recap what we've covered. We went through an introduction, of course, and we talked about categories and catalysts, and the market leader, institutional favorites, top competitors, turnaround situations. We talked a little bit about cyclical stocks and their inverse nature, and we talked about valuation, where David and I don't really look too much at a PE ratio. There's a few ways that we looked at it when it expands. Later on, as a stock makes a big move, you could start to see if maybe the stock has gone a long way, counting basis and looking at PE expansion. Of course, if the PE is super low, you have a PE that's 4, that could be an indication that something's really wrong. That's very abnormal. But otherwise, we're really not looking at valuation, because high growth stocks really can't be valued very well. We talked about that in depth. We talked about the trend. You want to be trading with a long-term trend and a stage 2 uptrend. Of course, what's the reason? Well, one of the main reasons is because 99% of every big winner made their big move in a stage 2 uptrend. So again, do you want to be in the 1 or 2% club or the 98, 99% club? I want a 98, 99% probability that I might be in a big winner, and that comes in a stage 2 uptrend. Fundamentals, went over the fundamentals. Remember, we're only looking at 3 things. Really 3 main things, and that's earnings, sales, and margins. And I showed you a whole bunch of ways to look at that and slice it and dice the numbers, from breakout years to quarterly acceleration to looking at the current earnings versus the growth rate. A whole bunch of ways to slice and dice those numbers, and also trying to find those code 33 stocks where you're getting all 3. The margins, seeing expanding profit margins, accelerating earnings and sales, and that's a really powerful situation. We've spent a lot of time on price and volume, from chart patterns, and you learned about VCP, volatility contraction. You learned about cheat areas, load cheats, David's MVP indicator, and all kinds of wonderful price and volume insights that David has given us. Entry points, of course. Then we talked about risk management. A bunch of sections on risk management, position sizing, and again, we just talked about post analysis. So that brings us up where we're wrapping up here. And of course, we're going to have a live trading day, and we're going to hopefully be able to implement some of this in the market in real life during live trading. And we're going to have special guests, and it's going to be a really great fun day. But I want to go over a few last things, and Dave, you can chime in at any time here. We as traders operate between 2 emotions all the time, and that's indecisiveness and regret. Those are the 2 sort of extremes that we fluctuate between at all times. Should I buy? Should I sell? Should I hold? And then after the trade's over, I should have bought, I should have sold, I should have held, because it's almost impossible to ever trade perfectly. There are some things you can do. You can try to perfect the buy points and have those trading rules from chart patterns. And of course, the loss cutting can be done near perfect, but then we have to sell at profits and we never get the high. So the reason why we make these mistakes and don't sell when we should and don't cut our losses and don't take profits and get greedy is because we're afraid to be wrong. And with loss cutting, you're wrong twice. You're fearful that you'll be wrong two times. You have the loss. So now when you take the loss, that's admitting you're wrong. You're wrong right there, right? Because you lost money. So now you were wrong on the trade. So that's being wrong, number one. Then you have the fear, you sell it and it turns around, goes back up. And then you say to yourself, I should have never sold it. Now I lost money. And if I just held it, I wouldn't have lost that money. So now you're wrong twice. So it's emotionally very difficult, but you have to realize that you have to manage that risk. You have to manage the risk reward relationship. You might have seen these charts before. Sometimes I've tweeted some of this stuff. And of course, I've talked a lot about many of these things in my book. But when knowing that you should sell when you're down just a little bit, but fearing that the stock's going to turn around and go back up, that's what gets you caught in all the trouble. It works on losses and it works on your profits. Fearing that the stock's going to go higher, you have a decent profit, right? And you're afraid that it's going to go higher, so you hold it. And next thing you know, like Dave said, he was giving back all his profit. That's how he turned a double into giving it all back. I did the same thing. I gave more profits back because being afraid that I was going to miss out on a bigger move. And then you start rationalizing, well, if it just comes back, I'll sell it. If it comes back 2 points, before you know it, it comes all the way back to your break even. And now you feel like a heel and you're up 20% and now you don't have any profit and you get yourself, everything just gets all screwed up because you're operating purely from emotion. So the thing you got to remember is that trading is not about being right or wrong, right? It's about making more on your winners than you lose on your losers and doing it as many times as you can. Rolling over an edge. If your edge is small, you've got to roll it over a lot of times. If your edge is larger, you got to roll it over less times. That's simple. So, but I want to show you something that I always like to show this at the end to illustrate how it's really all in your head. All this about loss cutting, there's a lot that's emotional and it's all in your head. Think about this. You bought a stock, right? And soon after the stock sold off and you cut your loss and you took a $5,000 loss on it. Now this could be, if you have a smaller account, it could be a $500 loss. If you have a huge account, it could be whatever, $50,000 loss. So it's all relative, but think of a loss that's a pretty good sized loss, right? You took a $5,000 loss. Okay, so now the next day, that stock takes off and soars, all right? And you would have made $25,000 on that trade that you lost $5,000 on if you had held it. How do you feel? How do you feel about that? Okay, so now let's say the next day, the exact opposite happens, right? The stock plummets. It gaps down on the open, and you would have lost $25,000. How do you feel now? Completely different, right? The first one, you feel terrible. You feel terrible. The second scenario, you feel great. You feel great. You're like, oh my God, thank God I took that $5,000 loss. The first one, you're kicking yourself. Guess what? Nothing's changed. You still have the $5,000 loss. See that Monday morning quarterbacking? If you do that Monday morning quarterbacking, you could have all kinds of emotions. Now, the market action is dictating your emotions.
Yeah, and I would add that if you missed a stock or you bought a stock and you sold and it eventually has this huge run and you start thinking, oh, I could have made so much money. I spend maybe 1 or 2 seconds on regretting past losses or past missed opportunities, because you have to remember, this is an ongoing game. It doesn't end. There's always the next trade, and there's always endless opportunities in front of you. Don't spend your time or waste your time, going back and going, I should have, could have, would have. Just know, prepare yourself for the next trade that's coming down, that's going to come sooner or later. That could be your next big winner, and really increase the value of your account.
And the main reason is because it's not about being right or wrong. Trading is not about being right or wrong. It's about making more on your winners than you lose on your losers, and doing it over and over. Let me show you another scenario here, and to illustrate a point. So you buy a stock at $100, right? And you let it go down to 80. All right. This example, you should never be in this example. You should never take a 20% loss on a stock. But let's just say you did. Okay. All right. So now some of you might hang on to that stock and wait for it to come back to even, right? You just refuse to sell it. The question is what is the difference on whether you sell that stock and buy a new stock, maybe one that has, a good chart? This chart, of course, now is broken down. Doesn't look very good anymore, right? What's the difference if you wait for this to come back, or if you buy a new stock and it goes up 20% and you make the money there? What is the difference? I'll tell you what the difference is. One word: ego. That's the difference. Because you just don't want to admit you're wrong. You want it to come back to even. You start saying, well, if it just get back to even, I would take this trade out. I would sell it. Well, you can sell it and buy another stock that looks even more promising. So again, this is about keeping yourself honest and really looking at how you're approaching things emotionally, and how you're framing the challenge. And once you start changing the way you look at trading, you'll start making better decisions. So always going with a plan. We talked about this, right? Formulate a very specific plan and write it down. Write down exactly what you plan on doing, your loss, where you're going to cut your loss. All this needs to be figured out ahead of the trade, before you place the trade. Execute the plan. See, having a plan is better than no plan at all. Even a bad plan is better than no plan. Now you can, of course, you can revise that plan. You go and you do your post analysis, you see what's going on, you find those common denominators, and you adjust the plan and you refine it. Okay, avoid calling audibles. Audibles are last minute decisions. You're sitting there, you're trading in the middle of the day, and then something pops up on CNBC and news item, and then you go and you place a trade and you haven't even thought about it the night before, and there's been nothing pre-planned. Stay away from that. Plan everything. You should know all your moves before the open, and those are the stocks that you focus on during the day. No audibles, no last minute calls, no calls from your broker or your friend or your uncle that they tell you that there's some, they give you a tip. Stay away from all that. All right. Once you're in the trade and you've gone in and out of the trade, you've sold it, you can now evaluate it, formulate a new plan based on what you've learned, and keep a journal. Keep very accurate records. You want to know the truth about your trading, right? Contingency planning. Your plan should what your plans should consist of is, one, your initial stop, how you're going to sell at a profit. You should have a plan for selling into strength and selling into weakness. You should also have a re-entry plan and a disaster plan. I'll tell you about that in just a second. But Dave, real quick on a re-entry plan, I mean, if you buy a stock and you're sitting there and you're watching it for, sometimes we watch stocks for months. And the fundamentals are there. You see it's got great earnings. It breaks out of a base. Maybe the market comes in for a few days. You get stopped out. Do you just throw that stock away and toss it away?
No, I keep on watching it because it could set up, and I put it in a list, and I put an alert back on it again. If the fundamentals are very good and the stock really hasn't completely broken down, sooner or later, if it's a great company, it's going to come back, set up again, and I can get it on the second time. And sometimes I've bought and sold a stock 2 or 3 times, taking very small losses. But the fourth time I bought it, where a lot of people would say, oh, forget it, I'm not going to touch this thing again, that's when the stock takes off and provides a great big profit for me.
Right. And sometimes it sets up even better. It improves. The technical picture actually improves. You got to think of trading just like a poker hand. You might start off with, a pair of 10s, and you flop a 10. For those of you who know, Texas Hold'em, you flop a 10 and now you've got a set of 10s. So your hand improved, right? That can happen. And sometimes you lose with aces, but that doesn't mean that you're going to fold aces the next time you get dealt them because it's the best hand. So again, you need a reentry plan. A disaster plan, this is where if your internet connection goes down, what are you going to do? Do you have a plan? I have multiple connections. I have a mobile hotspot, and I can tell you where the nearest Starbucks and all the places that have wireless in my area are. So I have a whole bunch of options that if something happens. I also keep mirror accounts where I keep the same amount of money in separate accounts, brokerage accounts. So for instance, if something happened to a brokerage account and I got locked out, I can then go into another account somewhere else and short against all those positions and at least collar my positions up. So let's just say you own 10 stocks. And I'm not going to get into a big long story about this, but I'll tell you real quickly. Pacific Brokerage was a brokerage firm that I traded at for many years out in California, and all of a sudden everything went down. I couldn't their phone systems, everything went down. Their online trading, I could not get anyone at the brokerage firm, and I was stuck in positions. Anyway, long story short, they had a satellite literally in space, and it was hit by a meteor or asteroid, whatever you want to call it. I don't know the technical term, but it was hit by something in space and knocked the satellite out. I mean, that's the kind of crazy thing. You never think of this, but that actually happened to me. And from that day on, I said, I got to come up with a plan because holy cow. I mean, a brokerage firm could go down and I could be in a bunch of positions and the market's falling and then I can't sell them. So you have to have a disaster plan. Okay, real quick, two very important questions that you should ask before every buy and sell. The next time you're about to make a buy decision, you should ask yourself, and this is how you keep yourself really tight on the criteria and you don't start just trading like a mad person. Ask yourself, if I could only make 10 trades per year, I was limited to 10 trades in a 12-month calendar period, would this be one of them? Just imagine if I said you can only make 10 trades, that's all you can make. You know how careful you would be? You know how much due diligence you would do and how much you would look for that perfect setup and that perfect breakout and have all the characteristics. You would be impeccable in your analysis because you only got so many bullets that you can fire, right? That's the question that you need to ask yourself. Now, does it mean you only make 10 trades? But put the stock through that test. Say, if I could only make so many trades, would this be one of them? And that will really quickly let you know if it's something that really looks good, or maybe that you're just trading because you want some action that day. The next time you're going to make a sell decision, and this, of course, if you don't keep a spreadsheet and you don't keep your numbers, well, then it doesn't mean a whole lot. But if you do keep your numbers and you keep that bell curve and you keep a spreadsheet, guess what? When you break your rule and take a big loss, it's going to be sticking on that curve. Remember, we looked at that distribution curve, and on the left side of the curve are the losses, and on the right side there were some outliers out there, right? We want, of course, lots of outliers on the gain side, and on the loss side there shouldn't be too many. Every once in a while you get torpedoed, but there shouldn't be too many. So if you're sitting there and you're at a 5% loss and a 7 and an 8, and now you're supposed to sell the stock and you start vacillating and saying, well, I'm going to try to hold it. If you start thinking to yourself, how's this going to look on my spreadsheet? What if that goes to 10, 12, 15, it's going out to the left, and it's going to be sticking out there. You got to look at that forever. That's going to be on your curve, right? You start thinking in those terms, that's when the spreadsheet makes its way into your trading. This is so powerful. There's nothing more powerful than this, than thinking in these terms. When you start thinking in these terms, then you're thinking risk reward. You're thinking mathematically. You're managing the risk reward, not just some abstract idea. It becomes real hard numbers with real visual context that you can actually see how that's going to distribute and lay out. It'll change your trading life. When you start using these type of techniques that I'm showing you here, it will literally change your trading life. I put on here some important trading rules. I'm not going to go through them. They're just for your edification. And also some of the reasons why traders fail to achieve big performance. Poor selection criteria is the number one. Most people have crappy selection criteria to begin with, and not cutting losses. These are like the two biggest mistakes, but there's a whole bunch of other mistakes here that I've pointed out that you can take a look at. The Machine Kelly syndrome, I call it, over trading, under trading, being paralyzed. I think I told this before. I can't remember. I think I told this story before in one of the previous sessions, but we had a client that came to several master trader programs for years and was on our daily platform for several years. And when I saw this person at the master trader program, came up and said, how's your trading doing? They said to me, I'm just about ready to start actually placing a real trade. This was after several years of being side by side with me on the platform and also coming to several master trader programs. That's someone who is really paralyzed and can't trade, can't pull the trigger. So again, there's a whole bunch of things that you can take a look at here. And finally, to wrap up, the 8 keys to super performance in my book, Think and Trade Like a Champion, I actually talk about these 8 keys. It's really important because these are really the linchpins of super performance and low drawdowns, which goes hand in hand with super performance, because you're not going to get big performance if you're having big drawdowns. So again, I would tell you to really read that section of the book very carefully. I want to tell you congratulations for completing the curriculum. We're going to have live trading, of course. And I think what happened to my screen there? Okay, that's fine. We're going to have live trading, and that's a full day. But you've completed the curriculum at this point, and it was a lot of information, right? We went through many hours and days and days, and a lot of information here. I want to congratulate you for taking this step. Dave, you got any final congratulatory words?
This is, to me, for especially people just starting, or even people who've been around for a while in the markets, this is really the beginning. This is the starting line. You've got all this information. All this stuff has been laid down for you. Now you've got to take it. You've got to put it into action, and you've got to learn from your winners. You got to learn from your losers, especially. And if you do that, you should have success. It's going to take a while. I mean, I've said it took me at least a couple of years, and I think, Mark, you said it took you almost 5 years to get all this stuff together. Well, we didn't have this type of program in front of us, but you've got a lot to work with. Study it, go back and study it over and over again, and live it, and then learn from it, and you should have some pretty good success in the markets.
Yes, you have all the examples in the workbook. So you have the stock examples. You have the examples in my books. You can even, O'Neill's books have great examples. So there's a lot there. And like Dave said, we didn't have this. It's a great time to be a stock trader. It really is. Don't let anybody convince you that it's too late and the market's gone up too much and the world is in trouble. And it's a great time, and it's going to be around for a long, long time. Long after we're all gone, it'll still be, the Dow will be at 100,000, and people will be saying it's too high, and then it'll be at 250,000, generations later, and they'll be saying it's too high. So just stick to be confident, believe in yourself, and stick to the rules, and keep improving, and do that post analysis, and you'll get there. So we're gonna wrap it up, and we'll be back for live trading on another day, of course, but for today, we're going to wrap it up here. And thanks, Dave. Talk to you later, and I'll see you on live trading day.
Okay, great.
Okay.
All right, guys, that is the conclusion of the morning session, day 4, the conclusion of the Master Trader Program, Super Performance Workshop with Mark Minervini for 2020. I have seen tons of appreciative feedback and comments. We do enjoy reading all that. We thank you. And that is why we do this every year. I hope we did deliver what you expected, and hopefully even more than what you expected is our goal. And my hair's not blue. I don't know why it's coming through like that. I think there's in the daytime, I think some of the natural light from the outside is making it kind of a white looks blue. It's definitely brown. Anyway, um, it is a lot of information, as I told you from the outset last weekend. I told you you're going to be going through a boot camp. You're going to be getting your PhD in trading. That's exactly what you have, more information than I will tell you most doctorate programs do have for whatever the subject matter is that they're teaching you. And you have 450 pages in front of you that are needing to be reviewed. And to go through any thoughts, we will be doing a replay. Um, and that is going to be tonight here, 6 o'clock Eastern time, 5:30. The room will be open. It's perfect timing because my Eagles are actually on TV today, so I get to watch them, and the game will be over before 5:30. We also, of course, with all the comments you guys are sharing with us, which we do keep to look at, we thank you for that. But also, we do appreciate those types of comments if you want to share that on your social media with your Twitter accounts, your Facebook accounts, your Instagram accounts. Any of those types of things is great to hear how much you've enjoyed it. It really, of course, is meaningful when attendees to the event share things like that that other people see, to really have that kind of firsthand experience of what it's like for you as an attendee and what your experience was. Obviously, we have our opinion of it, and I share that with people. But when they other people see what actual people attending the event have to say, that's of course really important and helpful as well. Like I mentioned, you can type in questions here with the page number listed first. I do see a bunch of you have been doing so throughout the event. This is going to be on just the materials from uh, really today. Yesterday, we took all the questions from yesterday. If you have a question from yesterday as well, I guess you could throw it in there. But we are going to be compiling all these questions for Mark to be able to go through that tomorrow during the live trading day. As a reminder, if you're not going to be coming back this afternoon to watch this again, which is the most sort of the peak of the mountain when we kind of crescendo here with the risk management day, is a lot of information. So we do encourage you to come back here, watch it again tonight. But 8:30 tomorrow morning will be the live trading day with Mark. The room will be open 30 minutes beforehand at 8 a.m. 8 a.m. starting at 8:30 is the pre-market routine of Mark. And a bunch of you have been asking for my phone number or email, so I did post that in there for you. Uh, you guys can go to the website, just click on the email button there too. That goes right to me. And obviously, for private access members, you certainly have the ability to click on the email button from within the platform. But my phone number is also available. So I do have a large list of number of names of people who do want to have me give you a call, or you can give me a call. I will be taking or making some phone calls even this afternoon here after I go get some lunch uh, for answering questions like that. Really enjoyed the whole time with you. Again, tomorrow is still another full day, 8 hours together, more or less, with Mark. So we're not over yet, not nearly over yet. Um, Replay tonight, 6 p.m. again. Thank you. Too many quotes, too many posts here for me to recognize and acknowledge each of the names, but definitely seeing them all coming through here, fast and furious, actually. We'll leave the room open again for a little while, so you still have time to put stuff in there. Don't worry about that. And Darren, the room will open at 8 o'clock. We'll start at 8:30. Yep. Yep. Risk management. Just one little golden nugget of Mark will pay for the course multiple times over during your career of trading. That I can assure you. Yeah. Right. Mark and Mark. Thank you, Drew, man. Mark and Mark. David and Bob. Not an easy acronym there. No, Nilesh, you know, even if you're trading part-time, that's a good question though. Even if you're trading part-time, you're able to apply Mark's methodology. You don't have to be a full-time trader. In fact, over 80% of our members are people with full-time jobs. So it definitely does not require you to be a full-time trader to implement what you're learning from Mark. You can be using this as little or as much as you want. And even if you're not able to be awake during the US markets, we have members from over 65 countries from around the world. Of course, many from Asia, Australia, who are sleeping when the markets are open here and very successfully doing their homework at night, putting orders in. The Hong Kong market, Singapore, you guys are exactly, well, 13 hours now for a couple months, but 12 hours. So the opening bell is 9:30, 10:30 at night. Still very reasonable for you to be able to put your orders in, even watch the open and then put your orders in. If you have that ability, of course, the better, the more information you would have. But I definitely have Australian clients where it's already midnight when the market's opening and they put their orders in during off peak hours. Singapore, sure. Hong Kong is probably our third largest international market, actually. So when it's 12 hours, it's pretty easy. Do your prep before the open at 9:30. Can even watch the market for a good hour or two. All right, Dean, can do that. Yep, European. Yeah, absolutely. Europeans also, if you have a full-time job, 9:30 is already kind of around 3:30 in the afternoon, 4:30 for Eastern European. So you can, at the end of your day, your work day, you can get started with your trading day. Mark, a review of the Asian stocks and Asia markets. That's a discussion point. Maybe one day. We have a lot of stocks to review in the U.S. markets. That keeps us quite busy. Full-time busy, actually. Okay, Tasso, thank you. Yeah, maybe that is part of it. $250% in the last year. That's awesome. Good job, Tang. That's not a small account. It's a very healthy size account. Not bad at all. Yes, Mark, we're aware of the billion people that live in China. That isn't another billion in India. That isn't a new fact that we just learned about. I like the way you're thinking, though. Those markets are, of course, not nearly as liquid and established as the U.S. markets, but Virgin markets is actually where Mark's methodology tends to do even better, just much more price and efficiency. You have to be local to trade those markets, of course, so we can't really benefit that from that here in the States. I think my white light here is definitely giving the brown color better. Alrighty. Render low floats can most definitely lead to more volatility, more movement. It takes less amount of buying to generate moves. So if you get a influx of buying or selling, that's going to be even exaggerated moves. Well, of course, there's more opportunities trading on an intraday basis, Charlie. You're talking about a smaller time frame. There's more and more and more setups that happen when you're looking at even smaller and smaller time frames. But I would say on a daily basis, as swing traders, we do with the service, 100, 125 trades a year. That's keeping people most people pretty busy just on a daily basis. So you could do 100 trades a day on a swing trading basis if you wanted to. I'm not sure if that necessarily is beneficial unless you are truly established in your trading skills. For most people, as Mark alluded to just a few moments ago, over trading is one of the things that will cause most people to not be successful. There are people typically looking for action. And if you are that good of a trader, you just do larger position sizing and build your account up. Day trading is a grind, quite literally a grind. I have a friend that's been doing it for 20 years. He doesn't look like he's his age, let's just say. Does not represent him well. Yeah, he was here earlier. He's not here anymore. You can talk to anyone who has been day trading and for even just a couple of years and know that they're stressed. Stress does not do the health well. It's actually my warm shirt from my old, very old telecom days, but it's actually a little chilly here in Florida today. I hasten to tell you what that means for Floridians, what chilly means, but it's high 70s, about 25 Celsius. That kind of is cold for us. We're more 80, 80, 26 and above kind of people here. I work out of my home office in Boca Raton. Yep, under 80. Start breaking out the jackets. My kids get the hat out, hats and gloves. Thanks, Les. We'll have to have a brief talk after the weekend, Les. Get some feedback from you. Yeah, there you go, George. I spent a lifetime up north. Philadelphia, DC, New York City. Never again. Yep, that's fine, Les. We can just talk then too. You as well. All right. Getting looks like down to some lingering questions being typed in, but the pace is slowed. So I'm going to take a break here. We will be back later. Yep. Tonight. See you tonight. And also Javier. Okay. Nice. Virtual, no less. Virtual, although mine is pretty impressive. Most people do think. 6 monitors here. Big 27 inches too. Yeah. All right. I got 1 minute to my kickoff. So I'm going to bug you on out here. And again, we'll be back a little later, guys. I'll keep the room open, even though I'm going to drop off here myself for a little bit. Yes. Year over year, Harinder. Year over year. Yeah, my Eagles season is over. Just for the fun of watching them. I don't get to watch them too often here in Florida. Yep, Fabio. Yep. All right, guys. We'll be back in a few hours. Get to do it all over again. This is why it is my most fun weekend or weekends every year. So we'll be back, and I'll leave the room open again for a little bit longer. You also want to see Harinder a progressive increase, ideally successive quarters, but the reported earnings are always a year over year comparison to last year's numbers. But you want to see that progressively increase quarter by quarter by quarter. The growth rate, you want to see the growth rate ideally increase quarter by quarter by quarter, even though the reported earnings are from year over year performance. Yeah, you can ask that, Mark, tomorrow. But Big volume with no movement tends to be a sign of churning, not something exciting, things to come. Just the opposite. But you got to be aware that there could be a big institutional block trade or something done on the dark trading exchange, and just gets reported at the end, and all of a sudden there's a big volume spike, but it could just be an arranged sale. So can't always trust that. All right. See you in a bit.